Broadcasting live from the Business RadioX studios in Atlanta, Georgia, it's time for On the Money, presented by Embassy National Bank.
Hi, everybody. Welcome to this week's edition of On the Money, the #1 small business show on Business RadioX. As you know, On the Money is presented by Embassy National Bank, and we are a nationally chartered financial institution, and our deposits are insured by the FDIC. On this show, we discuss topics designed to help you and small businesses succeed, because at the bank, we're proud of how we help small business. I'm your host, Joe Moss, the president at the bank, and welcome to the glorious Subaru of Gwinnett studio inside the beautiful Sonesta Gwinnett Place Hotel. We're at I-85 in Pleasant Hill, and so very, very comfortable setting. Today we're going to talk about residential mortgage lending, and to do that we have our very own Thomas Hogan with us today, who is the Senior Vice President in charge of residential mortgage lending at Embassy National Bank. So Thomas, welcome to the show.
Glad to be here. Thanks for having us.
I'm glad we can talk about this. And just so everybody knows, Thomas, how long you been doing residential mortgages?
August 2nd, 1998.
So we think that Thomas has some experience in this.
I've been around, yeah.
Yeah, so very knowledgeable, very helpful, and his department and is very, very responsive as well. So we've got a lot of stuff we want to talk about today, and then we've got a little bit of an actual workshop we're going to do toward the end with our producer here. But Thomas, let's talk about the state of the industry. Let's talk about the economy, kind of what you're hearing and seeing about home selling and time on the market and those kinds of things.
Well, you know, we being a federally chartered bank, we're able to make mortgage loans in all 50 states. I have obviously a lot more conversations about the state of the economy here in the Atlanta metropolitan area. The 18-county area, it's hard to keep a house on the market. The demand is so high, which seems to be running a little contrary to the state of the economy as a whole, where post-election there was a great deal of optimism about reduction in regulatory requirements and other things that might spur growth, in economic activity. We're seeing kind of a pullback from that a bit, and what it's resulting in is a bit of a journey of investor funds going back over into bonds from stocks or equities, and we're seeing a little bit of an easing of rates where we were had a fairly high certainty of increased rates throughout the course of 2017. We're just seeing much more of a stabilization on the 30-year fixed at or slightly below 4%, and on the 15-year fixed, at or right around 3.25%.
Right. Of
course, APR and pricing adjustment factors depend on a number of things that involve the specific mortgage strategy for the borrower, but as sort of a target, that's that.
And meanwhile, we've had two rate increases, short-term rate increases. So the prime has gone from 3.5 all up to 4. People don't think that's necessarily a big deal, but it's had a lot of impact on small business so far. And if you look at the yield curve, it's becoming a little bit inverted, which it typically means that the economy is starting to slow again.
Yeah.
So, and we have not seen hardly any growth in GDP. Atlanta seems to be doing okay. Southeast seems to be doing okay. But in total, things are kind of
Everybody that I speak to on a daily basis in my personal and professional life is gainfully employed, optimistic about the future, making money, having an enjoyable time with their family. And those things are not really indicative of a slowdown or negative economic activity. So I can certainly tell you that in the Southeast, and probably Atlanta in particular, the economy is doing well.
Yeah. Well, as you know, Thomas, I see a lot of these numbers too from the construction lending we do, and you hit it right on the nail. In my neighborhood alone, we've had 4 houses go on the market within the last month, and they were they all had offers within a day.
Yeah, that doesn't surprise me.
If you're in the right market at the right price range, you'll sell your house. If you're a buyer, you better be ready. So later on the show, we're going to talk about pre-qualification and the big benefit of that, because like I said, if you want a house, you better be ready. Okay. Well, let's talk about Embassy National Bank and where you are with our residential mortgage product, because the last time we were on the show, we were kind of just getting out of the gates. That was early 2016. So I think we've made a lot of progress since then. So why don't you fill everybody in?
We have. I'm very happy to report that the state of our mortgage department is very, very good. We are making the conversion to being a direct lender for all of our residential mortgage products that are conventional, jumbo, and up and coming, our FHA products. We are not shy about the business model that we've decided to pursue. A lot of investors, a lot of banks will pursue, for compliance and quality control purposes, offering the loan product of one or two investors so that they can really keep track of things as things, I guess, might get a little out of control for them. We've taken more of an entrepreneurial approach where we're offering the loan products of 7 or 8 investors, which are, it's proving with our low margin, it's really proving something that our customers are very much responding to, because we are able to really provide a wide range of really good solutions for people coming to us with a whole variety of different needs.
And in fact, that's, as you know, one of the niches we think we have found is that if you're dealing with a Wells Fargo mortgage guy or a SunTrust mortgage guy, you're going to get the Wells Fargo SunTrust product. Mm-hmm. In our particular case, we're going to make sure you're getting into the right product with the right rate, and you're still going to get all the service, still going to get the best rate, but you're going to be in the right product.
You know, I always said, would you rather go to a travel agent to have the opportunity to get a plane ticket on a variety of different planes going from here to Santa Fe, New Mexico, or would you rather just walk into one of the major carriers and have only one option on how to get there? And what we've done is imagine then if that one carrier opened up a travel agency inside of it, and you now have the opportunity to get the very, very best of what it is that it has to offer, but you also have the option to have alternatives to being able to provide whatever the solution is that you need under the same roof.
And talk about some of your recent wins, not in terms of names, et cetera, but in terms of time and, the application process, the time it took, happiness of the customer after the fact, the quality of the product. Why don't you walk through some of those? That's an impressive story.
Yeah, we really are applauding the process that we've put together. In a traditional mortgage company, there are a couple of things that we think that adversely affect the customer experience. So one of them, contrary to public opinion or popular opinion, is that it would benefit the borrower by having the loan officer involved in their file from start to finish. What we've seen is by making a significant investment in our personnel, both in the processing side, but also in the closing side, where we've got David Carr is 18 years experience processing and processing management for his entire career. What we've seen is that getting a loan file in a condition where we can submit that loan file to processing by having a really deeply qualified file, David's able to get that deal through the underwriting process very, very quickly. It's not uncommon for us to see a refinance loan get a clear to close from our underwriters in 7, 9, 11 days. I mean, it's remarkable.
And the value of having a real connected lender with a someone like David is it's very fluid.
It is.
You don't feel like you're being handed off. You feel like you're being assisted.
No, we actually we tell the borrowers that we approach this from a team standpoint. This is not a loan officer is king environment where everybody else then is a small guy helping that loan officer get that deal through the process. Our loan officers are 12, 15, 16 years experience themselves, and they're handing that file off to somebody who's 17, 18 years experienced. Everybody knows how to do their job, and there's a great deal of respect where we are. There's a great deal of competency, and you can see that in the way that people, the way that the loan officers are getting the deals into processing and getting those deals closed in a very efficient manner.
Let's talk about changes in underwriting as a result of Dodd-Frank getting put in place. There was massive hysteria in the market about how Dodd-Frank was going to change everything. Quite frankly, all I see coming out of it is a little bit better closing statement.
Yeah.
But everything else is still kind of the same.
We put a lot of in having the I guess the liberty of being able to create the mortgage division at the bank at a time when all of those regulations were fully in force and people were really not, people were still kind of scared of them, frankly. It really had us build our mortgage division in a way where we've got some very significant quality control waypoints throughout our process. And I can tell you it's only made our process better. I mean, I totally understand that there are draconian rules when sometimes compliance measures are not met. There can be steep fines and that sort of stuff. And I think that it is very prohibitive for the small business owner to be in the mortgage business right now because of the burden that compliance has. But for a process like ours, it has made us stronger. And a lot of people are talking about how wonderful it would be if Dodd-Frank were repealed or if other measures were taken off the table. And I can tell you that, at Embassy National Bank, we've got a process and it works. And taking away regulatory requirements is not going to faze us at all.
Right, and on top of that, you mentioned it, we are a nationally chartered bank, and that gives us a lot of flexibility in terms of who we have to report to with our compliance. And I'm seeing the benefits of that go forth to the customer, but also to the mortgage lender. And to our product. So we focus on getting it right, and we have one group we've got to report to with that, and it makes for a much cleaner process. Now, one thing the Dodd-Frank did get away from was getting people to getting mortgages in people's hands that had no business getting a mortgage. And it took away very exorbitant compensation that may have gone into a mortgage lender, but we've not been down that road at all at Embassy, so we don't have to worry about any of that.
No, and I'll tell you, the loan officers that have joined our team have had careers where they've been with companies that have not been exorbitant fee earners and radical product deliverers and that sort of thing. I mean, the group that we actually have kind of gravitated to the bank with level head and with a sort of a financial planning acumen with regard to trying to understand what's best for the customer.
Yeah, and I see it all the time in your offices, customers coming in, and they're getting a lot of help on top of the fact they're getting a mortgage, which is very, very rewarding for me to see.
Well, it's the way we do business. I mean, I spent 3 or 4 years with Buckhead Financial as a financial planner with regard to investment advisory and insurance and what have you. And I take a lot of pride in being able to sit down with folks and really talk through, like, what are they really doing? And, can they afford a 15-year mortgage? And, why are they requesting an adjustable rate mortgage at this time? And, those sorts of things I think sometimes catch people off guard because our society is so customer is always right kind of attitude. And, we had a 2-hour presentation this morning directly from employees at the Veterans Administration down in Decatur. And they came in and they were talking about the VA loan program. And they said that, the mantra all the way through the course of their presentation was, they worry about the veteran first. They've got their guidelines. There are ways that they can offer people concessions for the process in order to make sure. But they said, the bottom line is that what they're trying to do is they're trying to do what's right for the veteran first as a primary situation. At Embassy National Bank, we're trying to do, we've got kind of the only duality that we have. Number one is to protect the bank against risk, period. But then beyond that very fundamental, concept, we're trying to do what's right for the borrower first. The bank makes a margin on its deals. We're a for-profit business. We've got a reasonable to low margin. We're certainly not going to make our shareholders rich overnight with the success of the mortgage department, but that's part of the philosophy that we've all bought into, is that this is a marathon and that we're really building something that's going to be here long term, and that's going to come from being able to, the only people that we've ever been in competition with and been sort of equal on par with rate and fees are a couple of the credit unions, and they've got substantial weight to be as inexpensive as a financial institution can possibly be.
And they have a lot of flexibility in terms of the kind of mortgage they can write. But one thing, going back to what you said, making sure the customer's in the right product, that's one of the good things about the way you've set up our program, is that at some of the larger places, they may be saying, all right, we got a flavor of the month kind of thing, and you may find yourself forced into an adjustable.
Yeah.
But we don't do that.
No, gosh.
We need to make sure that they're going to be in the right product. We have an obligation to make sure that you're in the right product.
Yeah, our loan officers get compensated the same regardless of which program you choose.
And then on the small business side, I think we've run into a couple of individuals who basically live off K1s and capital gains, and that's a tough thing to underwrite.
In fact, it's important to note, especially to this audience, that Freddie Mac has had a reputation in the past of allowing for us to process mortgage loans with 1 year of business tax returns. Fannie Mae has always been a 2-year type shop. With the continued year in and year out improvements that the automated underwriting engines have made, Fannie Mae was starting to show us the requirement of only 1 year's worth of tax returns, but they've kind of backed off of it a little bit. In fact, Freddie Mac came out earlier this year and issued a memo that stated that if you've been in business for less than 5 years as a self-employed person, you will be required to provide the 2 years worth of tax returns. However, for those folks that have been self-employed for longer than 5 years, they still will recognize that and give you the option to be able to document the income with 1 year's worth of business tax returns.
And you're good at navigating that minefield for people. I've been watching you do it. So
one of the things I just can't ever understand is how if my job is if there are only a couple of ways to qualify someone's income off of a business tax return, regardless what's on there. There are rules for declining income. There are rules for one-time income that's not recurring. There are rules for all these things, and it seems like that's the one class that at mortgage college that everyone seems to duck out on. So. We're proud to,
and that's our market too.
Yeah,
the small business person.
We've got a lot of pride in being able to provide people with good, real mortgage advice.
Let's talk about pitfalls, and this is going to lead us into the next segment. But if I'm out there shopping for a mortgage, what kind of things do I need to try to stay away from?
Buying a car. Don't buy a car, and don't open up a new credit card, and don't go put a down payment on a whole new set of furniture.
Try to keep it clean for a while, right?
Keep me a clear lane between here and the finish before you go crazy and start, creating a more sophisticated financial picture of who you are than who you are today.
Now. But in terms of things I may hear from different mortgage companies, what are some of the things that they need to have their ears open about?
One of the things that I think we're going to talk about coming up is the nature of the pre-qualification. It's something that is something that should be taken very seriously by the prospective borrower. If your mortgage company is asking you for an application and suggesting that you are eligible for a pre-qualification letter, you should be suspicious, because there are lots of things that can happen when they analyze your pay stubs. If they see that you've got a child support payment that's taken out, or if you've got a 401k loan that's being paid back. I mean, these things actually have to be evaluated as part of the approval process. And if they don't get caught by your loan officer, they're going to get caught by underwriting.
Right.
And it's very, very important. One of the big things that has become an issue over the past year and a half is large deposits in your account. If you have a deposit in your accounts where you're providing your bank statements to show that you've got the funds necessary to close the loan, pay closing costs, and that you'll have some reserves left over. If you've got large deposits in those accounts that are greater than your monthly income, you're going to have to explain them, but you're also going to have to source where that money came from. And that daisy chain of documenting the source of assets can be cumbersome, it can be invasive, it can be very frustrating, and it can ruin a deal. And
there's stuff that you may or may not tell the lender up front that may cause the underwriter to get nervous. But let's talk about that process. So what you're saying is that if I go to a mortgage lender and he says, Joe, great news, you're pre-approved. Now, I know better.
Yeah.
But the guy on the street may think, hey, I'm pre-approved.
Yeah.
But still, all that has got to go to the underwriter. The underwriter's got to put it together in their package. Everybody does this, not just Embassy. Everybody's got to go through this. They're going to put together the package. They're going to underwrite. They're going to ask 1,000 questions, and you may or may not be pre-approved.
We don't use the word approval at Embassy National Bank, and we don't do it on purpose because your loan is not approved when you get your automated findings. Your loan is not approved when your file is submitted to underwriting. It is only approved after the underwriter has received all the documents that he or she needs to give your file a clear for closing.
Clear for closing. That is the term that is used in the industry.
It is.
Across the board. That's when you get approved.
That's when your file is approved, and not a moment before that.
All right. So if there's someone's out there shopping for a house, how far in the process? We talked about how you got to be ready. So you shouldn't just have a PreQual done. Anybody can write that letter for you. How deep in the process should you go?
Well, the way I tell people is, the first thing you should do is you should have an idea of kind of what it is that you feel like you might be looking for. And that really is sort of the gut feeling of understanding kind of what it is that you've been paying for your housing expense currently and coming up with an interpretation of what that might mean in your borrowing power. So if that means that you're looking at a home that is a $275,000 purchase price with a $250,000 loan, and you've gone into the amortization calculators on the computer, on the internet, and you've figured out what the payment might be, well, the first thing I'm going to do is kind of make sure that expectation has been set properly, because I need to make sure that you're aware that you're also going to have to pay a home insurance premium.
Right.
You're also going to have to pay property taxes.
Right.
You might have a homeowners association fee.
Right.
And depending on how much money you put down, you might have to deal with mortgage insurance.
Right.
So there's a lot that goes into even beginning the concept of thinking about how you're going to approach it. At Embassy National Bank, we actually invite people to come in for consultations to make sure that they start the process correctly.
Yeah, and one thing that we would do at Embassy, and this is across the board, anytime a borrower, whether you're a small business, whether you're mortgage or whatever, anytime you get a piece of paper from Embassy, you can bank on that letter.
You can.
There's a lot of folks that will get term sheets on the commercial side. No one can back up the term sheet. The same with the pre-approval letter from a mortgage company. In fact, we ran into that the other day where a gentleman came in and said, I've been pre-approved for this amount of mortgage, so therefore let me build this house at this amount of money because I've been pre-approved on the takeout. And we kind of scratched our heads and went, whoa, wait a minute, this doesn't make sense. You dug into the numbers, and that pre-approval letter was not worth the paper it was written on.
It wasn't. His debt ratio is too high.
Yeah. All right, we're going to our producer, Mike Salmon, has volunteered for this, and so we're going to go through a PreQual right now on the air. So, Mike, are you there?
I'm here.
Okay, so I'm going to leave it with Mike and Tom, and let's go through this.
Yeah, I think in protecting some of Mike's personal information, we won't go too deeply into the details. But I think what I wanted to give folks an idea to hear was the nature of the conversation in a more natural form for how it actually goes. So before we even start, I want to let you know that there's no question that you can or can't ask that is off the table, frankly. We are a really good mortgage operation, and we're capable of satisfying a lot of needs. And so before we even get started, or as we get started rather, have you thought about how much you want to pay each month for your housing?
Yes.
Okay.
And I like to pay less than I'm paying in rent right now because the rent these days is unbelievable.
Oh, I know.
I did a short sale on my condo, my townhouse, about 7 years ago. But kind of when the bubble burst. And all of a sudden, my home was worth twice as much as half of what I was paying for it.
Right.
So I was advised to do a short sale, which I did. Now 7 years later, credit's back up, everything is good, and I've been renting. And now I just renewed for one more year, but I want to go ahead and now buy.
Okay.
So I need to pre-qualify.
So how much are you paying in rent currently?
$1,300 a month.
Okay. So what we would do, and if I understand you correctly, you want to kind of stay at or below that number.
Yes.
So
I know people that can buy, because you can buy a fairly good size home for less than that in a mortgage.
Sure.
Oh, yeah.
From a percentage standpoint, though, I know that you're not planning to buy for a short period, but when you are ready to buy, what percentage do you think against the purchase price are you thinking that you'll be able to put down as a down payment?
I was told these days, and again, you're the one to ask, but that it's been a lot because since the housing bubble burst, you're expected to put 10 to 20% down.
Okay, none of that's true.
Okay, that's
just
that's what But
are you a veteran by chance?
No.
Okay,
but but 10%.
Okay, so I'll tell you a couple things that are very interesting. Number one, the interest rates for FHA loans are lower than the interest rates for conventional loans. Some investors will charge the same rate for both products, but that's just because they're making more money themselves on the FHA loans. We actually have a constant margin against our product line, so we actually offer that lower interest rate for the FHA product.
Let me jump in and say you got to draw the difference here between FHA and conventional.
Well, the FHA product is a government-backed mortgage product. It is a function of the Housing and Urban Development Department of the federal government, and the only difference is when comparing the two. An FHA loan is going to have a funding fee to close on it. Back in the old days, it was for the lower credit score type people. These days, it's actually for all people because the interest rate margin is different from the conventional. And the monthly mortgage insurance premiums are less than conventional. When a person is putting money down, though, on an FHA loan, in the old days, it was thought that the mortgage insurance premiums stayed on an FHA loan forever. And one of the keys about being able to get into a mortgage is you want the mortgage insurance premiums to eventually fall off, which they will once you get to the point where you've got a 20% equity position in your home. So as you pay down your mortgage and it's increasing in value, eventually you'll get there. The truth is that with FHA loans, for those 10% and less down payments, that's true. The FHA mortgage insurance does stay on for the life of the loan. However, when you do put 10% down, it doesn't. And a lot of people don't know that. So in the event that we're comparing apples to apples, where you've got this the funding fee, we would compare that against the interest rate expense and the mortgage insurance premiums on a monthly basis. But I would say that the numbers that I've been running over the course of the past couple of months, I would say more than 9 times out of 10, the FHA loan product for a 10% down payment has been the way to go. To give you an idea, if the conventional 30-year fixed rate for a conventional loan were maybe 4 1/8 today, I can probably guarantee you that the FHA interest rate would probably be 4.75 or 4.625. It's often a half a point lower, which creates a phenomenal amount more in buying power.
3 points.
0.375?
Yeah.
Okay.
So you said the conventional was 4 1/8, so the FHA would be
3.75, 3
Okay.
and
Yeah.
3.625.
So it's an advantage to the FHA program.
There really is, and a lot of people,
But you go back to what you said, though. The conventional lender may not tell you that differential rate.
Well, it's not a matter of it being, when we use conventional, we're talking about the loan product type.
Right.
A lot of banks, a lot of mortgage companies give you maybe 4.125 for both, where they might make a reasonable margin on a conventional loan, but they're making a killing on the FHA loan.
That's my point.
Yeah.
Be careful with that. Okay.
Yeah.
All right. So 10% down, $1,300 payment or less.
In the next year, because I got one more, I've just renewed my rent, so for one more year. In that next year, from what I've heard on the show already, don't go buying a car. Don't be opening up credit cards.
What you ought to do is you ought to come in and see me. Because
Okay.
let's talk about how much money you earn and what your current debt load is and what you're trying to buy and what your debt ratio can look like. Because you might perfectly well be able to buy a car and be able to still have a debt ratio that meets the underwriting guidelines.
In my case, I don't plan to buy a car, but I do have a car payment, and we'll have this conversation, obviously, that pertains to me. But should I pay my car off?
I don't see.
Does that help any?
I mean, it helps you because you're going to save the interest from your car loan.
Okay.
So that, again, a lot of what we do is about the financial planning aspect of what you're trying to accomplish.
But you're going to eat into that cash that you need for the potential down payment.
That's right. That's what I was going to say. And when we close loans when we process loans for more marginally credit score borrowers, not necessarily you clearly, but those folks need those compensating factors. So as a general rule, we want for borrowers to have cash in the bank when we're getting that automated approval, because it's going to see that borrower as being a stronger borrower.
Okay, we got some parameters here. I got my handy dandy 12C put up. So were you going to try to calculate a mortgage that he could do? Okay.
So before we get there, let's say that he's talking about a $1,300 a month payment. We're going to probably think that maybe that home insurance policy for this house is probably going to be about $75 a month, because it's going to be a single family home. Townhome or single family home?
Single family.
Okay, so no HOA, not in a neighborhood. Okay, that's good. We're probably going to say that the property taxes on this house are probably going to be about maybe $200 a month.
Okay.
So let's go ahead and let's say the mortgage insurance premium for this house is probably going to be another $75 a month. So let's go ahead and take that $1,350 and let's back out $350 of it.
Okay.
I
So
guess
we're
it's
at
down
$1,000.
$950. Put that in as a payment over 360 periods.
Okay.
And give me let's use an interest rate of 3.75, and let me know what that value is. While he's doing that, one of the things that we have that we've seen a lot of is automation in the mortgage industry. And one thing that I wanted to make sure that everyone was aware of is that mortgage companies are being offered a way of processing loans with Fannie Mae, where the employment and the income and the assets for the borrower can actually be verified through an automated process. The idea is to limit the number of documents that the borrower has to bring to the mortgage company. But at the end of the day, we're seeing that that's going to take a while to roll out. It's the product that we're seeing most popularly marketed as the Rocket Mortgage, because it has the prospect of being able to be a very fast way of processing a loan. The Fannie Mae is partnered with the Work Number. So if the company and the banks that the borrower works for and works with subscribe to the Work Number, then by going into a particular portal, we can put in the borrower's information, and it can check on asset account balances, it can check on employment verification, and also pay history. So that's called day one certainty, and that's something that we also have available through our investors at the bank. So the number that Joe was able to tabulate is about $215,000. So what we would do is we would say the 215, and since you're putting 10% down, we would obviously divide that by 0.9, giving us a purchase price of right around what, Joe?
$239.
$239. So let's just say $240. So I guess the first thing that I would do if we were in a consultation is ask you to go home and hop on the computer and poke around at the neighborhood it is that you're looking, the area that you wanted to look in, and see if you're finding homes at 240 or less in what it is that you're looking for. Because if you are, then you're really in a good spot. And if you're not, then we'll have to talk about, what you're...
Well, I would probably do it the other way, knowing that's my number. Those are the neighborhoods I'm going to look at is 240 and below.
Well, let me point out one other thing, because there's a lot of leverage here. If you say we're comfortable, and I don't know what you could qualify for, but the 1,300, if you found the right house or you found the right neighborhood, you may be willing to actually use a $1,350 monthly payment, and then knowing that you've got to pay a little extra for all these other things. But you're okay doing that because you're in the right neighborhood. And if you do that, that mortgage amount that you can afford jumps all the way to $292.
Yeah.
Just by going from $1,000 a month up to $1,350 a month.
Yeah. So there's...
So the $292 that's $324. That's a $325,000 house. So you really need to look at, you say, I don't want to pay more than my monthly rent. What he did was adjust it down for the other stuff you're going to have to pay for. But what I'm saying is that if you've got the income to support something higher than $1,350 and you want to do that because you want to be in a particular neighborhood, you could go up to $325.
I got you. I've got a question that pertains to me, but I bet you a lot of listeners, because our listeners are business owners, entrepreneurs, and so forth, and they own their own companies, own their own businesses, as do I. As I get my ducks in a row over the next 12 months to be prepared to take on a mortgage, do I need to show myself? Do I need to pay because a lot of business owners, sometimes they pay themselves as they go, as they may need it or not need it. They may not pay themselves 1 month. Do I need to show because it doesn't matter what the business brings in. The business can bring in $1 million. It's what I pay myself is what you're going to be grading me on. It's not my business.
Yeah. With a sub S corp and an LLC, obviously that income will flow through to your personal return.
An LLC just became an S corp.
So we'll qualify your income off of your personal return, and we'll actually look for where those numbers are coming from the business returns. We've got a lot of the bank does a lot of business with a lot of hotel owners who've got large assets. They realize a lot of depreciation, and we get to add depreciation back into the income calculation for their qualified income number.
But I need to go ahead and pay myself a set
No, you don't.
standard?
No, because as a subchapter S, what's going to flow through to your personal return is the net income of the subchapter S. It's going to be reflected two ways. You're going to have a K1 for one amount, and you're going to have a W2 for the other amount, and together those two amounts will equal the net income of the subchapter S.
So
both of those count.
My CPA just filed my personal taxes and the taxes for the business, for the S corp.
Right.
So I need to show both documents to you.
That's right.
Absolutely.
That's right.
Okay.
Right.
And let me tell you something that a lot of people think that they can qualify as a W-2 employee by switching their income mid-year to a W-2 and providing 30 days worth of pay stubs. And that's not true. Fannie Mae and Freddie Mac both require that you, if you're the owner of the business, it's okay to qualify you using W-2 income, but you've got to have a tax return where that W-2 income level has been documented as being the way that you actually do earn your living. And they do that to avoid the idea that a small business owner might decide to switch themselves to a W-2 for the purpose of qualifying for the mortgage and then go back to how it is that they regularly do business.
Right.
You said something, we were talking a little bit before the show, that because as we do the show live today, it's just after the tax deadline, April 15th, or April 2017. You said that it's still going to take you a couple months to get the returns from the IRS.
That's right.
So for me to be, I could not be approved in the next month or two.
That's true.
If I wanted to buy right away.
That's true. And I'll tell you
and that's an IRS issue, by the way. I mean, we see it on the business side all the time. We have to get a recording. I can't remember what that form is that we.
The 4506.
Yeah, the 4506, and it takes a while for those records to get posted.
The tax transcripts. It's true. Anytime that we're working with a borrower that is waiting to file their tax returns, it's not uncommon for people to think through how they're going to file their tax returns for the purpose of preparing for a mortgage. That's just the way it goes. It's important for people to know that in the mortgage process, we do get the 4506T form signed by the borrower because we do obtain in underwriting a copy of the tax transcripts. And because it takes about 60 days upon e-filing to have those tax transcripts show up in the IRS records, there is sort of a dark time immediately after filing your taxes, if they're e-filed, from when we can actually then provide that tax transcript confirmation and get a final approval on a loan. These are the things that should be talked about, though, honestly, in a pre-qualification interview with your loan officer, when we're really talking about who you are and what you're doing and how you earn your money and what's going to be required to actually get you successfully through the process.
Yeah, and before the show, you mentioned how the last time you got your mortgage, you just kind of walked in and showed them that when you breathed.
I basically showed them I was breathing, and I got a mortgage. And not only that, at the closing, they wrote me a check.
Wow.
And we wonder why the bubble burst years ago. Not that I was one of the people that didn't pay my mortgage. I paid my mortgage.
Right. So
it was too easy. But I did ask you, I said, I heard the pendulum went the other way, where now you've got to give your firstborn and jump through a lot of hoops, and you're telling me that's not true as well.
No, I think a lot has been overstated about the inability for a borrower to be able to get a loan, possibly commercial and residential. I think what we've done is just kind of come back to the fundamentals.
Just plan ahead, man. You're making a huge investment. So, sit down and think about what you're going to have to do and what the obligation is.
I want to touch on the debt ratio thing before we move too far away from that. I know we've got to get out of here, but when we ran Mike's scenario, we were talking about his level of affordability being at that 240 amount.
Yeah.
What we'll do is we'll actually create a range from what he said that he actually wants to pay and what the mortgage process will actually make him eligible for, so that he can see his range and so he can kind of feel through when he's looking for homes just exactly where he does want to be.
Back-end ratio, what is that range that we need to try to fit?
It is it's different from a financial planning standpoint than it is from an actual mortgage industry approval process. The standard is 45% because that is what the maximum is for a qualified mortgage, and that's where the liability starts to get heavy on the investor for default.
Does that include all the debts of the consumer on the 45%?
All the regular installment, revolving, and other
plus all these other costs that you put on top of the $1,300. So take anything you owe, plus all the cost of ownership, divide that by your gross income, and that cannot exceed 45%. But I will tell you that I would go underneath that.
Jumbo loans, it's 43%.
I would go underneath that.
You said that also that could qualify for even more, but I had to keep in mind that's more of a down payment then, because you want to hit that 10% threshold.
Yeah, that's going to be more. And on top of that, you really need to think about what you want your back-end ratio to be.
We really would wish that we could do this in an automated fashion online. And the truth is that there are so many moving variables that there really is there's a really core need for people to get good advice on exactly what that strategy is going to look like. And that's why you can't do it by slapping somebody on the backside and they wear a great suit and drive a nice car, and therefore you are just so sure they're going to get pre-approved. You got to get the income statements, you got to get the asset statements, you got to really have a conversation with the borrower and understand just exactly what are they trying to accomplish. And you got to work your way to understanding whether or not their credentials are going to get them to where they need to be.
And realistically, how far back do you need their tax records for?
For no more than 2 years.
Okay.
Yeah. In fact, if you've been in business for more than 5 years and we're in a scenario where we can document your file with only 1 year's worth of tax returns, we would use the 2016 since you've filed it. But if you had filed an extension, we would use 2015. We would provide the underwriters with a financial statements for December 31st for 16, and then a year-to-date financial statement, so they could see that there is no drop-off in your revenue or no unexpected increases in your expenses.
All right, everybody, we're at the end, but that's been great. I'm glad we went through that exercise. I'm sure that's helpful for a lot of people. But anyway, that's our show for today, and let me give you some numbers. Thomas, your direct line is 770-500-1278. If you're calling from outside, it's 800-560-9883. And as a nationally chartered bank, you can call from anywhere in the country, and we'll give you great advice because, as I'd mentioned before, if you get a pre-qualification letter from us, it means something, and that goes a long way. When you get ready to buy a house, you better be ready, especially here in the Atlanta area. So anyway, that's our show for today. And appreciate Thomas for being here. Mike, thanks for participating. This has been On the Money, the #1 small business show on Business Radio X, presented by Embassy National Bank. You can enjoy this show again or any of our other On the Money episodes anytime by visiting onthemoney.businessradiox.com. Our shows are available on iTunes as well, and you can also watch our episodes at Gwinnett Business Radio X channel on YouTube, and we're filming it today so you can sit there and look at our pretty faces. So I'm Joe Moss of Embassy National Bank, and remember, give Embassy a call and let us help you through this residential mortgage landscape that's out there. It's still not easy. You need to plan ahead and do all the right things. You're making a significant lifetime decision when you're buying a home. So that's it for today. We appreciate it. We'll talk to you the next time.